Welcome back to the Best Pro for You Trading Floor. Today we are talking about oil, and the situation is nothing short of historic. Are we heading back to 100, which is the 61.8 Fibonacci retracement? A very important next level resistance, and also a psychological, of course, level. If you're trading a broad challenge right now, you need to understand that this is a headline-driven market. So we have a massive escalation. Tankers are being attacked, and Iran has reportedly laid underwater mines in the Strait of Hormuz, vowing to keep the choke point closed. In response to US Israeli strikes, Iranian officials are openly threatening to hit American corporate infrastructure like Amazon data centers and banks, and warning that oil could even spike to 200 a barrel. To combat this, the Trump administration and the IEA just announced the release of 400 million barrels from strategic reserves. Actually, the EIA announced 400 million, and then the SPR, the Trump administration, another 170, if I'm not mistaken. But these two combined, that only cover around 30 to 40%, 30 to 40 days of global crude supply. It's a band-aid on a bullet wound. So let's look at the charts to see how this is pricing in. In this kind of extreme volatility, of course, the Bollinger Bands on the daily chart are really the right tool. They just blow out. Instead, when I use the volume profile, just mainly to tell you that, to show that the point of control is still down at 70. Okay, so as long as we are above that, then this is unlikely to change. Let's not forget that we have had a double bottom over here and a breakout of the neckline. When the neckline broke, we have had the 100% Fibonacci, which is the measured move at around the 100 level, okay, taken out. And we went all the way up to around the 168, perhaps even closer to the 200%. Let's see. Well, close to, yeah. So what are we looking at now? We're looking at the volume profile. The volume profile says that we have very strong support at 88, 87. This is an important level to pay attention in the short term to the downside. And we are looking also at the commodity index, okay, the CCI. I'm not going to use the RSI here because this is a more relevant indicator to use for the WTI. As long as we are above the 100, okay, and look at it now, we're actually heading higher for the third day in a row, it looks like it, okay, and we have barely moved up. So momentum is, of course, fading, but we need to see how this is going to play out in the short and medium term. Let's see how today close, importantly tomorrow, and also how the week opens, okay. Now, let's map the longer term structure. We are measuring from the massive macro high at 130 down all the way to 55. And what do we see? We see that we are closing, well, we might close above the 50 Fibonacci today at 92. If we do, long-term momentum or sentiment becomes biased to the upside. Now, if we close Thursday today, tomorrow, Friday, and then Monday above the 50, it's a confirmed breakout. The question is, are we going to be even close to that level Thursday, Friday, and Monday? I mean, are we going to have the opportunity to get in? This is something that, of course, we cannot respond to now, but we're going to see how this develops. So we broke out of the 50, and we are looking at the 100 next, okay? A cluster, psychological resistance, and the 61.8 Fibonacci. If we reclaim 100, the next magnet is up at 119.48, the previous peak. It is important to mention that apart from Fibonacci's and psychological levels, of course, we have also structural levels to take a look at, to remember. And do remember for now that below the 61.8, but above the 50, we've also got the 96 level. So that might also be an important going forward, an important level, because we could essentially go there and come back and retest this. If we retest this, this is going to become a validated support level, okay? And then we could look for a further, more organic continuation to the upside, regardless of the volatility, okay? But here is also the reality for best prop for you traders. The upside could be sharp, but equally the downside could be violent if BP stocks suddenly emerge or the SPR release floods the physical market and we don't see any sort of escalation on the war front. What you need to watch right now is the daily open and also the weekly open. First, on the daily open, let's not forget that we've actually opened at 89, okay? And just below that, at 88.60 is where we see strong volume over here, right? So if we do lose that level, then we open the door to 81.90. Okay, these are two numbers to remember on the daily. But more importantly, let's go again on the weekly. I want to show you, okay, the weekly candle. Despite the massive news, it's currently indecisive. It doesn't look like it's going anywhere apart from the spikes that we saw up and down, equal spikes, I would say. So tomorrow is Friday, the last trading day of the week. Do not get caught holding massive exposure over the weekend in a war-driven market. Gaps can and will blow your challenge. Look at this gap from the week before, from 91.50 all the way up to 98. Are we going to close this week below that gap or above? Are we going to have a red candle or a green candle? So far, it's red. So watch that 922 level support or resistance, whatever it might become, and the daily and weekly open. The fundamentals are pushing up toward the 100, but the weekly structure is stalling. Stay disciplined, manage your weekend risk, and trade what the chart actually prints, not just the headlines. This is Best Pro for you. Trade smart, and I'll see you in the next breakdown.